Welcome back to Real Estate Mindset. And today's video is going to be absolutely bonkers. Welcome to this morning's live video. Happy Thursday. Obviously, we're going to go into the CPI report and all of that stuff. But I wanted to tell you, after we do the housing market and market updates today, towards the end of this video, the value that I'm going to give you guys today is basically doing a market analysis on a property that I found in my local housing market. Pay attention. In my local housing market, I found a house, you guys, that I can purchase right now. I can house hack it. It has wedge, it can cash flow. So I'm going to show you guys basically how to do that. Once again, I've been getting a lot of requests. Here's what it's going to look like, what we're going to fill out today. Basically, we're going to look at the price per square foot, the rent. We're going to calculate the home value with the wedge. We're going to do the rent, purchase price, taxes, square footage. We're going to calculate payments and then calculate cash flow and wedge. So definitely stick around for that, guys. That's going to be towards the end of this live stream. And, as always, I definitely want to include, especially in my live videos, overwhelming value. It probably wait to the end after we cover the market. But first, guys, I want to ask you guys something essentially. And I want to challenge you, and I really want you to think about these questions, and I want you to ask yourself what these answers are. To you guys, what is a crash, right? What is a crash and why do you want one? You got to really ask yourself, do you just want one just because you're on the bandwagon of the housing market crash, the crash bro bandwagon? You guys really need to ask yourselves, why do you even want the housing market to crash? Is it because you want things to be affordable? Do you want to buy a house that's affordable? If so, do you know what affordability looks like to you? Do you guys see what I'm saying? If you guys don't know what affordability looks like, then how you're basically going to be stuck on the sidelines. In other words, what I'm saying is you really have to think what you want. Maybe you want the house market to crash because you don't want to get locked in your house. Maybe you don't want to get upside down and trapped, right? But the thing is you have to know what it is that you want. In order to do that, y'all, and I'm going to ask you, have you sat down with your spouse or by yourself and have you put down your goals? I'm asking you, and if you are looking for a house, say you want to buy a house within a year, have you been doing your market analysis? Okay. If not, you should be doing those things. The market analysis is going to help you understand what's going on locally, because we know that real estate's about local. So I'm going to go over that market analysis again, you guys, today. So if you guys want to know how to do that, but before I do, let me say good morning to everyone. And then I'm going to talk about a couple new segments I'm going to be doing on the show. And I'm really excited about it. But first of all, AJ, appreciate you, man. I see all your comments and emails. Appreciate it. Les as well. I know you're struggling, brother. I think you are. Sacred, always nice to see you. Mary, Sean, and Wendy, always love to see you guys. Juliet, I see you. Sheldon from the beginning. Florida Beach Bum. I wish I was a Florida Beach Bum. Good morning. Good morning. Appreciate you guys. There's Apple, Dean, Christy. Appreciate all you guys so much. There's my man Dental, Voval. There's Melissa. Melissa, tell me when you're ready to take that test, girl. Real Estate Mindset Community has got you. So we're going to pay for Melissa's real estate test once she's there. Definitely appreciate you. And I really admire watching you evolve, Melissa. So proud of you. Good morning. Good morning, everyone. There's my man, Don't Move. Good morning, you guys. Scarlett, Roro, definitely appreciate you. Don't move. So I'm going to get started here, you guys. There's my man, Mark and Rob. There's my man, Johnny. You guys should see Johnny's podcast for live streaming. It's absolutely amazing. Good morning, living. There's my man, Scribe. So we're going to get started right now. All right, I don't want to spend too much time. People always get mad at me. So the first thing that we're going to do today is essentially we're going to do the market update. But first, couple new segments I'm going to do on the channel. Now, the first one is I'm going to start doing live on location videos. I figured out how to turn my GoPro. Can you guys see that? What's up with my focus? I was hoping my focus would be better. Okay, so I've learned how to turn my GoPro into a live streaming service. So I plan on taking you guys to new build communities live. I have no idea how that's going to go. There's like construction, all kinds of craziness going on. So I'm going to try that. But also I want to ask you guys, I'm thinking about doing another segment on my channel, essentially where I review someone's financial situation. Now, I'm not a financial advisor. I can't give financial advice, but I can put myself in your shoes. So you guys, I've been helping consumers for over 20 years. I have seen so many bank statements and paycheck stubs and credit reports. I mean, my head would spin if I told you guys how many. But I don't know if you guys would like that. I would like to basically have some of our viewers send me in a copy of their credit report, paycheck stubs, bank statements, and basically let me review all of that and do a live, basically, what would I do if I was you? Right. So I don't know if you guys want to do that. And I don't know if you'd be willing to, send me your stuff. But if you want to, I think I want to do that. Let me know if you guys want me to do that. Basically just reviewing people's financial situation. I don't know if you want me to do it, but I think that would be super, super cool to do, because we're going to credit cards, how people spend money, and all of those types of things. So anyways, that is that. Let's get started on our update right now, y'all. I'm going to put my timestamp in for my update right now, and we're going to get started with the CPI is where we're going to start today. Good. I see some people saying it's a great idea to do that. Now, here's the CPI report that just came out this morning. And, I asked a question yesterday, and I asked you guys, is anyone even watching, or does anyone even care about CPI anymore? I mean, the thing is, guys, we're watching the housing market. That's why this channel exists. We don't care necessarily about eggs and bacon. We're caring about shelter. Shelter is a huge, huge expense and weight on pretty much all inflation gauges. So here's what this says, you guys. First of all, the index for shelter, okay, shelter is what we're watching. The index for shelter was by far the largest contributor to all monthly items, all item increases, accounting for over 90% of the increase. And that's why that's why I can't get behind the CPI, because I don't care necessarily. I know it all, matters, but I care about housing, the prices, the rent, everything about the housing. And you guys can see, like we've been saying, inflation in the housing market is extra sticky. More than likely, the rates aren't even high enough. More than likely, as we saw this year, we know actually the rates weren't high enough. The residential mortgage rates weren't high enough. But again, you guys, 90% of the CPI increase is straight from shelter. So almost all of the CPI and inflation is in the housing market. So in other words, there's nowhere left for them to go. Everything is kind of calming down a little bit, disinflation. Some places have deflation, but one thing that's steady is right here, shelter. You guys see that? So shelter is right here. Now, month over month, shelter's up 0.4, okay? Here's the problem. Annualized shelter is at 7.7, okay? So in other words, we still have a massive unaffordability problem right now in the housing market. I'm pretty sure every single person can acknowledge that, but I did want to let you guys know CPI did come out today at 3.2%. It was predicted to be at 3.3, so it was a little bit better. But one thing, again, that is really, really sticky, is really, really a problem for most Americans, is the shelter. And that's honestly what we're talking about here. Maybe you disagree, but that's the report there. I'll link that, guys, if you want to go in like line by line. I don't even care. I'm not going to waste your time with eggs and bacon and medical costs. But this is what I really want to show you. Let's hop on over to the CME FedWatch tool right now. And let's see how the market has reacted to this new report. Now, remember, you guys, the CME FedWatch tool is basically an indication on what the Federal Reserve is going to do with interest rates. A lot of times they get it right. Sometimes they get it wrong. But one thing that we know about reviewing the CME FedWatch tool is it changes regularly. So if something happens in the economy, one of the first things that I do is I come here and see if the trajectory of what the market is thinking is going to happen changes. So I want to start by showing you guys September. Now that CPI has come out, again, basically the market is writing off a second rate hike in September. Jerome Powell, essentially, the Federal Reserve, has told us probably at least 2 more rate hikes. They said basically at least 2 more rate hikes. It's changing, but I do want to tell you guys the market's not pricing it in. So what this means is if the Federal Reserve does hike rates, the market's not pricing it in, more than likely the stock market and the market will crash, right? If they're not pricing in what the Fed's going to do properly, it will go down for a few days or something like that. So that's why we watch this as well. Let me show you guys November. November is only sitting at 27.9. So again, the market is saying, let's see, December, look at 23.4. So this is super low. The market's not, the market is writing off the Fed, and that's a fact. And we see that right here. But let's go into next year in 2024, okay? Now, here's the interesting thing in 2024. They're saying, the market's saying there's a higher likelihood of a rate cut in January versus a rate increase the remaining of this year. Why is that important? Well, if you're thinking that you wanted to refinance in the future into a lower rate, it's probably a good idea to understand when interest rates will probably come down again. Don't y'all agree? But anyways, I'm not saying the market's right. I'm saying that the market believes the Fed is going to cut rates in January, not raise rates in 2023. Interesting, wouldn't you say? So let's go to March. Now, March, 40% likelihood. You guys can see that right here. That's what that represents. 40% likelihood of a quarter cut, and then 20% total of a 50 basis point cut right here. Let's look at May. That's interesting. Very interesting. So, okay. So here's what the market's thinking. This is what they're thinking. Overall, this is what they're thinking. Nothing is 100%, obviously, you guys, but this is what the market's thinking. They're thinking a quarter, basically a quarter cut in March and a quarter cut in May. So that's what the market's thinking right now. So again, no more cuts this year. Cut in March of a quarter basis point and a cut in May quarter basis point. Again, that's what the market's saying. Let's look at the 10-year, you guys. We watch the 10-year, obviously, because the 10-year tracks 30-year fixed rate mortgages. And look at this. You know, what we've been saying, and I hope you guys are able to answer some of the questions I asked you in the beginning of this video by watching my channel and basically just being aware of certain things that are going on. But we see that the 10-year treasury cannot hold at 4%. Literally, the market cannot handle the treasury at 4%. It's crazy, but more than likely, that's going to go up. There's so many things that are showing that that's going to go up and stay into the 4%. I don't know for how long, but it's probably going to stay in a 4% for an extended period of time. Probably, I don't know, a quarter, like 3 months, maybe 6 months. Who knows? But we know the market is essentially telling us it is not capable of holding on to treasuries at 4%. And that's long-term yields, right? Keep your eye on that. Now, let's see what that does to interest rates. Even though the 10-year dropped under 4%, residential mortgage rates, thank goodness, have held above 7%, which is good. It's okay if the 10-year drops per se, as long as the residential mortgage rates stay elevated. Why am I saying we want mortgage rates to stay elevated? Because we need to curb demand. If we can continue to knock out demand, the housing market, based on the laws of supply and demand, should automatically rebound. That's the thing we're missing. We're missing demand being crushed right now. And I just don't understand how there's so much demand. It's really quite shocking to me. But anyway, 7.05% is what rates are sitting at. And that's at primo credit. That's not even, normal people. So about 7.05% is where we're sitting at. Let me show you guys the 10 and the 2-year inversion. Now, this was uninverting. Okay, let me put the max on here. So we're watching this because basically this is the indication of a recession. When this reinverts over the black line, generally we are led into recession. But, if we go back to the 70s and 80s, inflationary recessions, we can see that we actually entered recession while we were already inverted. Do you see that? Twice. Now, after that, no. After that, basically after the early 1980s recession, it has always reinverted before recession. So 1, 2, 3, 4. So we had 4 recessions after where it reinverted and then recession. But honestly, you guys, because we have such a horrible inflation crisis right now, I wouldn't be surprised if we went into I still think we're going into recession, but I wouldn't personally be surprised if we went into recession while we were still inverted because of the inflation. Now, take a look at this. This is the 5-year break even. Basically, 5 years from now, this is what the market is saying inflation is going to be. And now this has been going up. I'm not saying it's unhinged, but if this does get unhinged, it's going to be very bad. I don't think it's going to be honest with you. I think it will go into the opposite direction. I think this is just greed in the market talking right here. It is what it is, but look at the 5-year break even has gone down over the past 2 days. Now, as far as rate cuts, okay, from the Federal Reserve, probably they're going to want to see this under 2%. So once it maybe hits like 1.9-ish, that's going to be an indication, one of the indications that the Federal Reserve will start cutting rates. But right now, you guys can see it pretty much skyrocketed up middle of July, and it's been staying up elevated in the 2.2 range. Very important data set. Now, let me show you guys this. Okay, this is the total assets from the Federal Reserve. So, part of the quantitative tightening is basically eliminating the Federal Reserve's assets. So for example, they'll sell a treasury, say they'll sell a treasury to us, and then they'll burn the money and make it disappear, right? So we can see they are doing it. And this is the brick wall we hit at the beginning of the year, right here. You guys see that? That's the brick wall that stopped the recession and stopped the housing market from declining right here. At least that's what I believe. This is a lot of money. $400 billion is going to have an effect. But the beautiful thing, again, you guys, this has been going down. So as long as they keep this course, that should be a good thing. Now look at this. This is very interesting as well. This is a reverse repo market right here. What's very interesting about this, y'all, is this has actually been going up, not down. A lot of people were basically estimating that this was going to be depleted by October. Basically, what we're seeing here, this is a 1 day. Basically, look at the reverse repo market as like the 1 day treasury. So like I'm buying with my money, I'm buying 1 month treasuries. This is banks right here taking deposits and money and putting it into a 1 day treasury, for a lack of better words. And this is yielding something like, it's over 5%. So probably what's going to happen is, in order to get this money, so the Fed wants this money, Treasury wants this money. In order to get this money, they're probably going to have to raise the bond yields to get the money out of there into the Treasury. So it's just really shocking. So this is telling us that the rates aren't good enough. The banks want to park their money here. They don't want the, even short-term maturity, which is really astonishing. Again, like short-term maturity, like a 1 month or a 6 month, they don't want it. They haven't been wanting that since about July 20th. That's interesting. I wonder why that is. So again, that has been overall going up. Intriguing. Very intriguing. So we're going to listen to our first video right now, y'all. Let me pull this up for us. And if you guys can, just let me know that the audio is okay. And I would surely appreciate that. And again, I want you guys to stick around for the market analysis. The market analysis is so vital. And if you guys can, please let me know that the audio is okay here. I would appreciate it. And I hope you enjoy our first video. This is a little bit crazy.
Our next guest expects a slight reacceleration for the July number, but says any inflation improvement doesn't mean a soft landing and expects a recession by later this year or early next. Joining us now is former Federal Reserve Vice Chair, PIMCO Global Economic Advisor, Rich Clarida. It's good to see you, Rich. Welcome back.
Hi, Sarah. Good to see you.
So what are you expecting tomorrow? You think we're going to have a problematic number?
We're looking more at the core number. The headline number could actually pop up just because of the base year effect. But we got a good print on core in the last report, and we expect a similar print. We could be wrong, but a core number in the range of, say, 2.5% or so annualized. And that would certainly be better than we've been having.
So what will that mean for September, for the Fed, or November?
I think the Fed is truly data dependent now. I think that the chair, for example, in his press conference emphasized that they could pause in September, they could hike. I think they'll want to keep their options open. In particular, Sarah, they don't want to declare mission accomplished too soon, but also they can't be tone deaf. I think they do need to acknowledge that the data is improving, especially on the price inflation side, less progress on the wage inflation side.
So why wouldn't they just keep hiking? Market's not expecting another hike for this year. If there's still work to do on inflation and they haven't destroyed the job market, far from it. Third quarter GDP from Atlanta Fed is tracking over 4%. Yeah. Why not just keep going?
Well, Sarah, I tend to agree with you. If I were there, I would be supporting getting another hike in this fall. But I'm not on the committee, and some of the rhetoric, including recently from John Williams and Pat Harker, have indicated that they're receptive to the idea that they could be done. But I think you raise, as usual, a very important point. Inflation forecasting has not had a good track record in the last 3 or 4 years, including mine. And although there's a case for forward-based policy, right now, I think I hope they do look for inflation actually to come down durably and stay there. And so I think it's too soon to declare mission accomplished.
Although, Rich, you were asked about a month ago about some of the market wagers about a March cut. And you did suggest, at least at the time, that a cut in March or an indication that the March meeting would involve cuts makes some sense. You still feel the same way?
I do, and I'll tell you why. Under the Fed's, first of all, remember the Fed baseline projections at the June meeting had that additional hike in the SEP dots. Indeed, the vast majority of the committee thought they would need that additional hike. And under that projection, they had inflation, core inflation next year falling into the twos. And so I think if we're sitting at the March meeting with core inflation on a year-over-year basis in the twos, I think they will begin to entertain cuts. But that's only conditional on getting there. There's a lot of road to travel between here and then. But I think under that baseline outlook, that's a sensible thing to start thinking about for next spring.
So does that mean we're in recession by then?
Well, I think the odds of at least a technical recession as declared by the MBER are more likely than not. You know, historically, whenever the unemployment rate's risen by more than half a point, it's been declared a recession. My sense is that we're going to need to see some modest rise in unemployment to get wage inflation into the ballpark consistent with the inflation target. I'm aware that there are a lot of folks on the other side now who are calling for a very soft landing without a recession. I'm in, Sarah, what I'd call a softish landing camp, where we'll get some rise in unemployment, say into the mid fours, as what we're going to see in order to get inflation into where the Fed wants it.
All righty. So
My
the
business
Fed
runs-
is data dependent. All right, very interesting. The Fed is data dependent, so why not higher rates? You know what I mean? I don't know. Maybe I just don't know about the economy, which is probably the reality of the situation. But let me show you guys this chart right here. We're going to go into a second video here in a minute, but I wanted to show you the housing inventory active listing count for the United States, because this did update 2 days ago and it sucks. This is not what we wanted to see. This is the first time in, let's see here, probably since June of 2022. Basically, it's showing that for the first time in about a little over a year, you guys, that we have less year-over-year inventory. So right now, our inventory, active inventory, is sitting at 646. All right. I was hoping for a lot more than that. Last year, the biggest increase of inventory was June to July. All right. So that was the biggest increase of inventory. We didn't get that huge increase of inventory this year. A lot of the people are basically saying the reason why we're not getting new listings coming to the market is the golden handcuff effect, or the lock-in effect, where basically some sellers can't even afford to sell their house. Maybe they want to sell, but they can't even afford to sell. But y'all, where I was hoping we would end sometime this year or be around this year was right about here, 1 million active units. So I'm a little bit worried about this, because again, we're not having this shoot up like we did last year. So there's a shoot up last year. But the thing is I'm not giving up, because if for example, 2 months from now, if we have overwhelming job loss, this may change drastically. So we don't have that though right now. Right now, what we have is oh, everything's okay. You know, media headlines, oh, inflation's going down, it's time to buy a house. That's what we have right now. It is what it is, you guys, but I wanted to show you that did update. We're going to go into our next video right now. And again, we're almost to our market analysis section. And I really want you guys to pay attention to that. It's a very important part of what I'm trying to show y'all as far as the housing market. Now, this is interesting. This next video is from the Compass CEO. He's incredibly bullish, all right? It's important to listen to all aspects and opinions, in my opinion. But he's basically thinking that what's going to happen next year is essentially what happened this year. So let's hear what he has to say, y'all. And if you can, please let me know the audio is okay. We'll get this started for y'all right now.
Robert Refkin joins us now. Market's not that impressed, Robert. Stock's down 14%. It's had a nice run up this year. What was your main message?
Yeah, I can't control the stock market, but I can control our expenses. And in the second quarter, we grew market share, we grew margin, we grew EBITDA, and we've proven that in the worst of markets, we can be free cash flow positive, generating over $50 million in free cash flow. We turned promises into results. We said we'd bring OPEX to 950. We said we'd be free cash flow positive. And now we're saying that we're going to bring OPEX to $900 million in 2024 and 2025. And when the market recovers, our expenses won't. And the result will be significant free cash flow to investors.
Where are those cuts coming from in the business?
And so there's no incremental program. It's just ongoing in terms of vendor management. There are a lot of vendors that we have that we don't need, and more offshoring and outsourcing of some of the roles that we already identified in the past.
The revenue declines. Is that sales volumes falling? Is it prices? What explains that?
It's both transactions and price, but more transactions. Transactions are down approximately 20% year over year, and the other delta is price. That's the weighted average price of a listing, although prices in the country have gone up every month so far this year. For the Compass portfolio, we tend to be more weighted towards certain high-end markets like California that haven't been doing as well.
We talk about people sort of with these velvet handcuffs with low fixed mortgages, but there has been some survey work that suggests they're interested in maybe listing one day. What do you think cracks that? Is it unemployment where they have no choice or something else?
Yes, their buyers have accepted 7% mortgage rates as the new normal.
I haven't,
but sellers haven't. When you have 30% of homeowners locked in at 3% or below, you have 70% of homeowners locked in at 4% or below. They consider that a financial asset and don't want to lose it. So the delta between 4 and 7 is just too much for too many people. The current view is once it gets around 5, 5.5, we'll see a significant unlock of inventory.
So, Robert, when you talk about the market basically going sideways from here for some period of time, which obviously is not exciting investors, is it just rates that are going to change the dynamic?
Rates are the key issue that will change the dynamic. I believe once mortgage rates get below 5.5 in a sustainable way, that's when the market will really recover.
We're pushing 8% now, going the wrong
You could
direction.
be waiting a long time.
We could be waiting a long time. And so I think that's what the market's realizing is that next year could look a lot like this year.
What about which markets are hot and which ones are getting particularly hit?
Yeah,
Especially after all the weird COVID dynamics.
I'd say that the hottest markets are still the warm weather, low tax states. So you have the Carolinas, you have Texas, you have Florida. But new development continues to be the hottest of the hot. People want things that are move-in ready. They want to pack their bags and go from New York to Texas, California, Florida, and just drop them off. They don't want to redevelop homes.
But can developers get the financing they need right now to put up those kinds of apartment buildings, for example?
So that's one of the silver linings. It's a great time to be a developer or a home builder because prices are increasing, and prices are increasing because of the rate lock issue. There's not enough inventory in the market, so buyers need to pay the right price in order to get the seller to list. And so we saw 2 months ago, the home builder sentiment turned positive, and they had the largest number of housing starts since 2016.
Although the Journal's got a piece out today about mortgage real estate trusts turning off the spigot in terms of new loans. Is that worrisome?
It is worrisome, but developers also giving buy downs to home buyers by 1 to even some cases 2 points from existing mortgage rates.
I mean, so his job is to be bullish. Can we blame him for saying the things that he's saying? I mean, seriously, can we really do that? I don't think so. I mean, his job is to be a bull, right? And to figure out how to push that narrative. That's his job. That's what he has to do. So what we're going to do now, y'all, is we're going to move into the market analysis. And let me show you kind of how I set this up. And first of all, if you don't stay, I appreciate it. Everything is going to be bookmarked. This is going to be the value part of this video. I always try to put, I'm going to try to put a lot more value into my live videos, whether it be briefly looking at credit reports, appraisal value, even income calculations. If you guys want to kind of see how a loan officer would calculate income based on self-employment or based on a corporation, 1120, whatever, I want to start showing you guys like that boring, important stuff. It's boring, but it's super important. So again, today, this is what we're going to fill out, y'all. Let me see how I want to do this. Probably just do it like, let me show you first of all. So this is what we have to fill out today, okay? This is what we're going to fill out today. And basically, I want to show you guys that I have finally found a home in my local housing market that I can buy right now, and I can basically cash flow. I can basically move into the house with a wedge. And I want to talk about the benefits of that. And basically, the purpose of this segment is to help you guys formulate your goals and to help you understand what it is you're actually looking for in a housing market crash. What are we looking for? We're looking for our house, right? But my question to you is how are you looking? I don't want you to stay emotional. I don't want you to be all over the place. Stay in the data, watch the data, and you know, it is what it is. The data is what it is. So we're going to do, okay, a market analysis on Kingwood. And I'm going to show you guys. It's crazy what's happening. And first of all, listen to me. This is my own personal local housing market. I'm seeing multiple changes in my local housing market, you guys. I'm seeing price cuts. I'm seeing new inventory price cuts. I'm seeing all kinds of stuff go on in my house market right now. And that's the advantage of having access to multiple listing service. Multiple listing service has the freshest data. We don't have to wait, right? I can access sold properties, and accessing sold properties is super important. So let me take you guys over there right now. And again, we're going to be filling out this right here. Okay, so in order to fill out this, the first thing I'm going to do is I'm going to fill out what I've circled. Okay, so let's go and start this exercise right now. Okay, I'm going to queue up like this, y'all. Okay. Now, this is my access. This is my local MLS. This is Matrix. If you're a realtor, this is basically the same thing you should be doing. If you're doing what you probably should be doing, which is your market analysis, having a realtor help you with your market analysis, here's how they do it. So the first thing is okay, say I want to move to Kingwood, right? So I'm going to put in Kingwood because this is what we've been looking at this whole time. So I'll put in Kingwood. I have 83 total listings. You can't see that because my name is right there, unfortunately. So I'm going to hit results. And you guys know immediately where I'm starting is price per square foot. So I'm categorizing this list by price per square foot. And I want to tell you guys, even though the inventory, okay, hasn't been shooting up like I was hoping, look at the prices now. Do you guys remember what 4 weeks ago we had only one price under $120 a square foot? And everything else was like what, one in the 120s, mid to high 120s. Look at how many homes are now in Kingwood under 120. Look at that. This has dropped considerably. And this is new listings and price cuts from existing, you guys. Remember, we didn't see this just 4 weeks ago. We now have 4 properties under $120, and look at the total number of properties under 130. We now have 13. So, and look at all these price cuts. These arrows right here represent, I'm not going to say distressed sellers, but it could be distressed sellers because they're price cutting. The market's locked up. I'm going to tell you guys right now, maybe you don't see it in your market, Vital, but in my market, in my neighborhood, it's locked up and ain't no one buying right now. I'm going to tell you that, and we can see that. So anyways, when I do this, you guys, I now know the best price per square foot in the entire city. So in the entire city, this house right here, best price per square foot, $113 a square foot. Let me show you guys this house. Again, and this is like one of the rare houses that I would actually represent someone, right? So if anyone wants this exact house, email me and say, hey, I want that exact house, because I ain't going to show you any more houses except for this one, because this one is safer. I don't want to be a part of people buying overpriced houses. I want no part of that. But this is a little bit better. And I want to show you guys, look at $113 a square foot. Look at the pictures of this house. This is a nice house. Look at this. So, oh my gosh, this is a nice house. It's great square footage. Let's do our numbers. All right. So say I'm interested in this. I am, for myself, it's the best price per square foot. What do we do next? How do we know this is a great deal? I want you guys to comment below and tell me what's our next move now. What's our next move, Vital? Okay, I don't want to hear you complain unless you're doing your homework, Vital. I'm going to pull your comment. Vital is a superstar. I'm going to talk to our viewers about Ninja. That was so hilarious, Vital. I'm going to get there. But what do we do next? You guys, how do we know this is a great deal? How do we know? We have to do our market analysis. And is real estate local? Yes, real estate's local. Is it about location? Yes, it's a local and it's about location. Therefore, what do we do our market analysis on? Tell me what we do our market analysis on, you guys, please. We do our market analysis on the subdivision. Remember, we do it on the subdivision. It's the subdivision that matters, not the entire city. It's that subdivision. What's the name of this subdivision? It's Kings Manor, okay? So we have to do an analysis on Kings Manor. All right, you guys see that? Let me move my picture. See, I already put Kings Manor right there. All right, so we have to do a market analysis on Kings Manor. How do we do that? Well, that's easy. It takes minutes. Okay, so now that I've found a house right here, so this house is selling for $315,000, right? The square footage is 2,770. So I'm going to start putting that on this form real quick. Okay, so the purchase price is $315,000. Let me actually reverse this, you guys. I'm going to do it like this, okay? So the purchase price, we know. I'm doing this a little backwards just because we already have the info. because remember, we want to do the market analysis first, but the purchase price is $315. The square footage of the property was 2,770 square feet. Okay, now I'm going to go back here and let's take a look at the property taxes. If we go down here, we can see the property taxes is 2.65. I think where here it is right here. So it's 2.6975. All right. So what I'm going to do is I'm just going to take the purchase price. This is not how you do it, you guys. There's an assessed value, but I'm just going to take 315 like this. And I'm going to multiply it by the taxes and then divide by 12 because I'm calculating the annual amount right now. That's how expensive property taxes are in Texas. Okay. Anyways, I'm going to divide that by 12 because I want to calculate my monthly cash flow. So I calculate monthly taxes. Okay. So I go back here, my taxes per month. This is important to know because we got to figure out cash flow. Okay. So far I know what my purchase price is. I know what my square footage is, and I have my taxes, right? Now what we need to do, you guys, we're going to go back over here. Okay, I'm actually going to do this like this. All right, let me move this calculator. So now we're going to go and do our market analysis on the subdivision, which is Kings Manor. So let me go back to search. You guys, this is, pay attention to what I'm doing here because I'm going to give you guys a little bit more that I haven't given you yet. So what I'm going to do is now I need to do a market analysis on Kings Manor. I want to know how much homes sold for in the last year, and I want to know how much homes rented for. I need to know what they rented for and what they sold for. So I'm going to go again. I'm going to go here. I'm going to hit sold right here. And all I'm going to do, guys, now remember, I showed you we can go yearly, but like 2022, 2021, 2020, but I'm just going to go back 1 year. So I'm putting 360 days. That represents 1 year back. Now, remember, I have to keep it local. So I'm going to the subdivision right here and I'm putting in Kings Manor. Okay. Right here. And what I see is there's 37 homes that sold in Kings Manor over the last year, right? All of these homes. Now pay attention to what I'm about to tell you. This is how you remove outliers from your data. I did a live the other day on a subdivision and there was a couple outliers that messed my numbers up. So as a realtor, this is what you need to do. You need to go through this list and make sure there's not like $1 million house in here, right? Or like one that only sold for 50,000, because you can remove these comps by unchecking them. But I've reviewed this data and there's not really any outliers. So I'm going to select all of the comps. And all I'm going to do, you guys, agents in the house, it does the thinking for us. You go to stats. Oh my gosh, I can't hit it. Stats, and you go to tabular. Why is this screen sharing in the way? Okay, there we go. Okay, so I'm going to go to stats and I'm going to go to tabular. Okay. And now I know, let me see here. Is this correct? Boom, last 32 days. Okay, so now I know the average home over the last year in that subdivision sold for $135.61. So let me show you now what we do. All right, so we go back here. I'm going to put price per square foot was $135.61. You guys will see when I'm done with this how easy this is, okay? Then I'm going to go back to here, this camera, and I'm going to queue up to go back into do our analysis now on the rental market. So we've done our market analysis on the subdivision for value. So we now know in the last year, average home sold for in that subdivision, $135 a square foot. There are no outliers because we've reviewed the list. Do you guys follow me? Now we have to do the same thing with the rental market. So let me scroll back here to MLS real quick. I could have just gone up here. I'm going to go now to the rental MLS. This is so cool. Realtors can do this. If you guys are realtors, I really hope you're providing your clients with this type of data. So I'm going to go to the rental market right now, which is the same thing, except it just calculates rental. I'm going to go to sold right here, and we're going to see what homes rented out for over the last year. And don't forget, you guys, it's hyper local. So we're going to go Kings Manor right here. Okay, so 34 homes. You can't see that because my name's in the way. 34 homes were rented in that subdivision over the last year. So let's hit results. Okay, make sure there's no outliers here. Okay, everything looks about standard. So this data is good. Okay, right? is maybe you can consider this an outlier right here, because look at how much that's renting out for. And look at the square footage of the house. So it's renting out for 113, but that's also 118. So it's a bit of a mix. So what I'm going to do is I'm going to select everything. I'm going to go to stats. I'm going to go to tabular, and it's going to tell us the average home sold, rented out, easy. Look at that. Kingwood's so easy because it's basically $1 a square foot. All right. So now I know, I'm going to go back here. Okay. That homes are renting out for the last year, $1 a square foot. Okay. Now what I do, y'all, is I multiply. Let me do it like this, actually. Okay. Let's calculate the wedge. Okay. So basically, we have enough information right now to fill out the half of this, okay? Because one of the missing pieces of information is going to be to calculate our payment. But first of all, what I want to do is show you guys the wedge in the house by essentially multiplying the average price per square foot of $135.61, multiplied by the square footage, okay, right here. So I'm going to multiply that price per square foot by the property square footage, and I'm going to see how much it should be selling for, which is $375,639. It is so important to walk into properties right now with wedge because, and let me tell you why. If you guys buy property right now with wedge, you're going to have a way easier time refinancing in the future when rates go down. If you guys don't be walking into properties with wedge, rates go down, properties go down with it, you're done. But if you walk into a property with wedge, home prices can technically go down 10% or whatever it is, and you're still okay. Do you understand what I'm saying? Anyways, I'm sorry. Now, also, we're going to calculate the rent. How do we do that? We multiply the $1 times, again, square footage. So what do we know? We know that this property can rent out for roughly $2,700. And I want to make a point as well when I'm doing this, you guys, this is how much I'm paying in rent right here. I'm paying $2,400 a month in rent. So if I can get this property to cost me less than my rent, would it be a good idea for me to buy it? Maybe, right? Maybe it would, because I don't want to waste my money in rent. The problem with that property is, guys, and I'm going to tell you guys right now, the biggest problem was it's not my dream house. Because it's not my dream house, I really don't want it. But what can it be? That house I just showed you could be a house hack. It could be something that I buy for a year as I ride out the housing market and avoid renting. And then when everything does flip, I could then turn it into a rental as long as I cash flow, or I can refinance it to reduce my overhead and then go buy another primary residence. That's what I'm talking about, house hacking. But let's see if we can get there. We don't know if we can get there until we know our payment. But let me show you guys the wedge. So in order to find the wedge, we take the home value right here. Okay, the average home value, what it should sell for. It's not selling for that right now, probably because of the unaffordability. And we subtract the purchase price of $315,000, which gives us wedge of $60,639. That's our wedge. So when we divide that by the $375,639 that it should be valued at, we know that we have roughly 16% wedge. What does this mean? What does that mean? Do y'all follow what I just did? We're not talking about cash flow. All we're talking about right now is wedge, okay? Which means that house should be valued more, but it's not listed for that because something's going on and it just can't sell. Do you guys think maybe the reason why it's not selling is because interest rates are 8% right now and they just cannot sell? And all of the buyers are like, the well-qualified buyers are like gone. Do y'all see that wedge? That $60,000 is so important. And that's one of the ways you use the data to find the deal. And listen to me, if values now go down 10%, right? If the housing market crash, if values go down, let's say 15%, am I still okay? The answer to that question is yes, because I have 16% in wedge. You guys can see it, 16% in wedge built up. Again, so It's not quite 16%. It'll be like more like probably like 14%, because remember, it doesn't have to go down as much as it goes up. But in other words, what I'm trying to tell you is by purchasing property with some wedge, it allows us to be able to refinance in the future. What you don't want to be doing now is buying houses at 8% interest rate with absolutely no wedge, because when interest rates do go down, you can't take advantage of that because your house doesn't have any equity, and you need equity in order to refinance. Do y'all understand what I'm saying? All right. Anyways, I want you guys to reference this part of the video, because now what we have to do is we have to calculate the payment. Okay. And I think my camera just shut off over here. It did. Oh my God, my camera shut off. So we got to calculate the payment. In order to do that, I'm going to do this. All right. So we're going to calculate the payment. I put $300,000 purchase price right here, you guys, because I'm like, I can probably get them down from 315, but let's put 315. Okay. We're going to put 315. You guys can access this as well. This is just the Google mortgage calculator. If you are actively looking for a house, you should contact your loan officer. Your loan officer is going to know a lot more. But this is a helpful tool for consumers. So I put 315,000. Now remember, you guys, I generally want to do 10% down. Okay. What I'm going to do, actually, let me refresh this so we can start from the beginning. So I'm going to hit property tax and insurance. Let's go 315,000. Remember, I'm like 10% down, which I'm not going to recommend you do at this point. I'll tell you why. We know what the property taxes are because we've already calculated that, right? Where's my property taxes? $708 a month. Dang it. I have to do it annually again. So I'm going to go 708 times 12. Okay. So 84.96. So I'll put 84. That's a lot. 84.96. So the homeowner's insurance is probably going to be more. I'm going to put like $1,300 in homeowner's insurance right there. And remember, at 10% down, I want to pay the PMI. So in a normal market, I'm going to put 10% down, pay the PMI. I'm not going to do that in this market. What I'm going to do is I'm probably going to, when I purchase my primary, I'm probably only going to put 5% down. Why would I only put 5% down? Because I'm going to wait to refinance. And at the time of the refinance, as long as my property, listen to you guys, as long as my property still has wedge, then I don't need to put 10% down. Did you guys see what I'm saying? You followed me there? So if I buy this house 6 months later, rates go down to 5%. If I still have the wedge, when the lender does the appraisal, it's going to look like I have 15% of equity, even though I've only put 5% down. By doing that, that will allow me to have a lower interest rate. And when I finally pay my PMI off, the PMI liability will be less because it'll appear as if my house is valued more. I hope you guys understand what I just said. That is so important. But anyways, I'm going to do this at 10% down, and I'm going to pay off all of the mortgage insurance. Okay. So let's go up here. Oh my gosh, look at the rate. Okay. So that's it. So I have really good credit, you guys, and I know where to shop my mortgage at. So my rate will be about 6.5%. Now what we have to do is we have to figure out if we can get my rent payment of $2,400. Remember, my rent payment right now, you guys see, is $2,400, right? So my rent payment is $2,400. Let's see what we can do. So we're going to go like this again. So the total payment on this house, look at $2,608. Look how close I am to renting. So this house, based on my own calculations, is only $200 more than I'm paying in rent, right? So it's very, very close. But let me ask you guys something as well. Does this property cash flow? Right? Look at this again. Okay. What can I get for rent? What can I get for rent? And this is the principle of what I'm trying to tell you guys. What can I get for rent? I can get this for rent, right? So what's my mortgage payment? $2,608. Y'all see it? So I can get for rent $2,770. My mortgage payment is $2,608. What does that mean? That means I have cash flow. How much cash flow do I have? Not much, but I do have some cash flow. All I got to do is take what I can get in rent, $2,770, minus my mortgage payment, okay, which is $2,608. That means there's $162 in cash flow. Is that a lot? No, that's not a lot, but it is cash flowing. Okay. Payment what was it? $2,608. That's what I'm looking at. So I know it's a huge mess. It's a huge mess here. I'm so sorry. But you guys see what I just did? And let's talk about this for a second, okay? So when we look at this, we can really kind of like, all right, now I have the data. What should I do? If I purchase this house, it's going to cost 10%. I have to pay the PMI up front. So it's probably going to cost me like $45,000, right? As a consumer. So it'll probably cost me $45,000 to move in. But the cool thing is my payment only goes up $200. If I ever need to sell the house, I could probably cash flow at $160 a month. Not a lot, but it's better than being upside down. Now, the thing I love about this house that I just showed you is the $60,000 in wedge. Again, that $60,000 in wedge allows me to refinance later. And that's really what I want to do, because I don't want to have a 6.5% interest rate, and I don't want to have PMI. I don't want to have mortgage insurance. So if I'm purchasing in this market, and by the way, you guys, I hope this all made sense to you. Can you guys let me know if that was helpful? You can assume FHA loans as long as you qualify. But let me know if that's helpful, you guys. I think it's helpful because, again, it allows us to, when we purchase with wedge, it allows us to it gives us a better likelihood of refinancing in the future. And then being able to sell the house and not being trapped, right? There's a lot of advantages. But the thing that I didn't do is I didn't see that house and go into it emotionally. I saw a house. It looked good. I looked at the data, I put everything on paper, looked at the pros and cons, really, looked at the numbers, found that if I buy that house individually, I can house hack. So should I buy that house? Let me ask you, should I? It's not my dream house. And what am I looking for? I don't necessarily want to invest in real estate right now. What I want to do right now is find my home. So that's not a home that I love. That's not my forever house. So I don't want to buy it. But here's the thing. If I was house hacking, if I was willing to house hack, which I'll have to talk to my wife over the weekend because we still may buy it. If I was willing to house hack, what I would do is I would purchase that house at 5% down. I would wait for interest rates to drop because it is a mathematical certainty that interest rates will drop. When interest rates drop, I do a refinance. If I have to put another 5% down, I'll do it. But I refinance into a lower rate and I pay all my PMI up front. Then I stay in the house for whatever the requirement is, either 6 months or 12 months to satisfy my residency requirements. And then I convert it to a rental, and then I go find my dream house once again. So that would be a way that I would house hack. But again, you guys, I think we're in a situation right now where I don't know if I would put 10% down and pay all the PMI up front, because there's too much going on right now. So I think the better thing to do right now is to find out if you are going to, first of all, I think the better thing to do right now is to wait it out. And really what I want to going back to my first question, what is a housing market crash and why do you want one? Affordability, not to be trapped, right? So what is that? Is that 2019 prices? Say a housing crash to you is prices going back to 2019. Let me ask you, Vital, all of these people, what did houses sell for in your area in 2019? Do y'all know it? Do y'all know that information? What if you can find a house right now that is selling for 2018, 2019 prices? Do you know what that looks like? And are you in a position to get it? That's what I'm trying to show you guys right here. Even though there's not a lot of deals right now, the more and more time that goes on, and if we head into the housing market crash, what we're really saying is when the housing market crashes, there's going to be more deals. That's what we're saying. If it crashes, if prices go down, there's going to be more deals. And basically, odds are regular people could potentially get a deal of their lifetime. But I also want to point out that there are some deals right now, not a lot. There's barely any, but there are some deals right now. And the more and more you guys become aware of these numbers, the value, the rent, the cash flow, refinancing in the future, equity, wedge, the more you guys know, the higher probability that you guys will win on the other side of this thing. Now, again, the one, in my opinion, big thing we're missing from the housing market crash, and I hate to say it, is the unemployment. And if you guys watched my video with Jack, I think 2 days ago, he really went into the employment and the labor market. And the reality is it appears that it's just headlines. We're just seeing headlines, great labor market. But when we really look at it, you guys, we month over month, we lost 500,000 full-time jobs, not counting yellow. If we annualize that's 6 million full-time jobs a year. If we lose 6 million full-time jobs a year, unemployment's going to be what, 4 or 5%? And things will change like this. So I could still win that dollar, you guys. I just wanted to say. So I really hope you guys like it. Let me pull up some comments and have a discussion. Before I go, I want to throw up your comment real quick. AJ, not around me. Foreclosures are all over the place now, and houses for rent are sitting with no takers. The reason why I'm throwing this comment up is I want you guys to understand that his market's different than, say, someone else's, Vital's market or someone else's market. So that's why our community is important. Because what's happening in AJ's market is not what's happening in Jeff's market and in Vital's market and in my market. So the more and more you guys are commenting and giving us intel and showing us what's going on in your market, the better it helps us all, right? But it needs to be real information, not just emotion, right, Vital? Now let's read this one. Oh, I'm going to get to you, Vital. That was epic. I forgot. Now here's something from Sacred. Honestly, I found my dream home recently in the boonies of Austin. It's overpriced by like $30K. Still debating if I should jump on it and ask for concessions of the overpayment. So he found his dream home. I'm going to tell you guys right now that should be one factor in buying. So check, okay? But Sacred, $30,000 over, right? You told me nothing about wedge. You told me nothing about price per square foot. Did you do your, I'm going to tell you right now, Sacred, you didn't do your research, did you? I know you didn't do your research because of how you phrase this question. You have given us no idea of cash flow and wedge. And I would say it's okay to bid $30,000 over asking as long as it's way under market, right? Who cares about listings? And we need to see the data. So here's the thing. Let me say it like this, Sacred. If we're still in the summer months of home buying and you've already found a house of your dreams, what do you think the landscape is going to look like in October or November of this year? Don't you think there'll be even more deals and even more options? I do. So, but again, it's your decision, brother. That's crazy, right? Okay, the fact that we're so close to estimates tells me there's some manipulating. I mean, you guys, come on, there's an election next year, right? Here's something from Vital. I saw this. This is crazy. I had dinner last night. I talked to my family. I'm like, did y'all hear UPS drivers are going to get $170,000 in salary? I'm like, I quit my job. I'm quitting YouTube. I'm going to be a UPS driver. That's a lot of money. So the thing is can they even afford that? If we're not even in recession yet, can they even afford that? And a real quick shout out to Vital Signs. So funny. Vital Signs was on Economic Ninja's live broadcast yesterday, and he upset the Economic Ninja so much. And honestly, when I saw and Economic Ninja was beating up Vital Signs, I was laughing like crazy, Vital. But I was also like, that's my little brother. Like, leave him alone. He's with the real estate mindset crew. You better leave that man alone. So I was like, dude, lay off Vital. But also, Vital, that was hilarious. I want to give you guys a props to that. If you guys want to see Vital upset Economic Ninja, it starts at the 26-minute mark, and I think it was like the second or first live yesterday, but that was so funny. Leave these people alone, Vital. You're a bully, Vital. You're a bully. He's not a bully. He's a really good guy. All right. So his thing is what if they go bankrupt, right? More affordability. Let's see what else here. The Fed will not cut rates anytime soon. They'll initiate universal basic income before they'll consider cutting rates. So there's just, there's a lot of different, theories here. Okay. Last thing real quick. No, this is what Vital's saying. Powell looks like a boss right now. No recession. I'm going to actually say the opposite thing of what you're saying, Vital. I actually am starting. It's not a full boss yet. It's not full boss mode. I'm starting to think that Powell is a boss, not because there's no recession. I'm thinking Powell's a boss is because he's fooling so many of you, Vital, into the fact that we're not going into recession. And for that, I think he's a boss because I think it's all in our face. Look at GDP. Look at the labor market. Look at the run-up in equity. Look at the prices. Look at the defaults. It's low still historically, but the trajectory is all there. It's still the defaults, depending on what we're looking at, is still low though. So, and then consumer. I mean, there's just so much. But I hear what you're saying. I'm thinking the opposite thing, literally the exact opposite of you. But we'll see in time, man. I mean, he's right. I mean, he could be completely weak. We don't know that yet because the game isn't over being played. They're still playing the game. Twisted Tech, I appreciate you, man. I'm always going to try to put value into my videos. I definitely appreciate the love right there, my man, as always. All right, you guys. So I think that's going to do it for today. Oh, wait, you know what? Let me do this one thing because this guy's name is Travis. Okay. You got me, Travis. You got me. Okay, I was gonna close this up, but this is interesting. So, Travis, talk about assumable loans. Huge deals to be had. You're missing the opportunity to give yourself and your viewers value. So, let's talk about an assumable loan. First of all, Travis, did you get one? And were you approved? And can you give us more insight, like on the process? I'm like, great deals. You left out the great deal part, like the details. Like this is just fluff. But let's talk about assumable loans. There are people that are trying to purchase real estate right now based on purchasing and assuming the loan. And what an assumable loan is basically like FHA, for example. You can assume someone's loan. And why would you want to do that? Because they have a lower interest rate. Okay. Let me tell you what's happening with assumable loans. So investors are like, I don't want to do assumable loans. Okay. Investors are like, assumable loans, it's a hassle. You may not even get qualified. You have to get approved. They'll probably say no to you anyways. But these investors working around the system are basically doing what's called it's as is. So they're purchasing homes as is. And they're illegally violating the law and the contract, and they're assuming the mortgages and paying it themselves. What's the problem with that? If the lender finds out, it's very rare, but if the lender finds out that they just sold their property to you without you paying off that loan, they could call the entire loan in due immediately. And let me ask you guys something. If lenders find this out and you got like a 3% on that loan and they find out that you illegally assumed that loan, don't you think they'll call that due? I don't think they want 3% mortgages out there personally. So I believe that lenders are going to come crashing down on all these as-is investors because it's illegal. It's illegal. You're violating the contract. You can't just assume someone's loan. So let me tell you another bad thing about as-is. The seller is liable the whole time. That's right. Whoever the seller is, if they sell the house to an investor as is, if that investor stops making the mortgage payment or if that investor is late, whose credit does it hurt? It hurts the sellers because it's still on their credit. And not only does it hurt the seller, it locks the seller out of their purchasing power because the mortgage is still on their credit. So that's the workaround to assumable loans. I will say though, Travis, that if there is a seller and they're offering an assumable loan, you guys may want to take advantage of that. Because assumable loans can really allow buyers to get into a property at a super low interest rate. But I will say this, okay? There's a process and there's a right way to do that. And generally the right way to do that is if you find a house, you got to go through that seller's lender and you have to send in your qualifying documents like income documents, asset documents, your credit report. And then there's more. Then the lender would have to say, okay, Travis, you qualify. The loan is now your loan. But then there's an additional step. And then after that, the seller has to then go back to the servicer or lender and get a full release of liability. Because remember, the seller's still liable. But again, you know, this was actually, I think, a regular practice back in the 90s. And my wife's parents actually used to do that. So, you know, the release of liability is important. So in other words, what I'm saying is assumable loans can be a great thing, but do it the right way. Don't take shortcuts. There's a lot of people out there, especially investors, that are pushing that workaround and cutting corners. I'm going to tell you guys, it's just not worth the risk. Even if that risk is low, imagine the lender calling the full loan due. If you can't pay it, sorry, we're going to take the house back. And they'll take the house back if it's got equity. Why would they work with you if they could just take it equity? So in other words, be cautious. Just be cautious is my point. And you guys, other than that, they do have waivers, yes, and that's the thing. So they have waivers, and that's what I'm saying. That's the second part of it. So the buyer gets approved, but then the seller also has to go back and get that waiver as far as the additional liabilities. And you guys, not all of them will give you a waiver. They should, but not all of them will. And the point is here, again, it's a process. It's an entire process. Don't cut corners. All right, that's what I'm saying. Other than that, you guys, I really appreciate your time this morning. I hope you guys have a great day. I hope you guys are out doing great things, loving people, understanding the market. And other than that, if you're out there investing in real estate, you know I wish you luck, and I hope you